Everybody. Welcome to Friday, another Talk Money with Tom show. Really glad that you could join us today. This show is about trying to help you with your retirement. We do that by answering your questions. So you can send those in now at asktom@talkmoneywithtom.com. You can put them in the chat. You can send them in during the week. I'll get a chance to kind of look at them and what have you too. By answering your questions, hopefully we can, get everybody's education level a little bit higher here. I think that helps a lot. Retirement is a lot more fun when the finances are working. It just is.
When you don't think about them.
Yeah, exactly. When they're in place and you have the right things, and obviously health is more important, but finances fit in there too. So we created this channel, Talk Money with Tom, really kind of specializing in what's happening in the markets, retirement planning, tax planning during retirement. Whether you're 20 or 80 and looking forward to retirement or already in it. There's something on the channel for you. You can hit the subscribe button and the little bell next to it to get notified when we put new stuff in there. But go ahead and take a look at that. There's over 1,500 videos now. And of course, if you want to just meet with us, you can do that also. There's a book appointment button at the top of our webpage, and you can set up a time to meet with Ethan and I to discuss your specific issues. So looking forward to today's show. I hope everybody gets something good at it today. I do like to start off each show with kind of a summary of what I saw happening in the market this week, and it's actually been a pretty eventful week altogether. There's a lot going on, and so let me share the chart. So this chart again going back to 2019. I can see that the pandemic, the big run after that, those types of things. So little tail here. This is weekly data. You can see that this week was up.
And it was a good bounce after the last few weeks.
Yeah, we've had quite a few weeks here in a row where the market hasn't done well. Even before that, it was basically going sideways. Of course, this is off of a huge run. If you look at that chart, it still looks pretty good. I mean, that run is still amazing that happened so far. And having a little drop down like we did seems quite normal to me, kind of how things work. And so I just want to zoom in a little bit on, the more current data. So this is just the last, couple of months. You can see, that low point there. That was last Friday, right?
Yeah, we basically touched that 30 on the
RSI. right above my shoulder there. The RSI, which is this purple line, it hit that kind of low point of 30. That's usually a good bounce point historically, and you could see it was stretched up there, up in that 70 range for quite a while. So again, this is kind of a normal scenario to have this come, and so we'll be looking for some things to happen. For example, like to see this kind of trend line. It's a short trend line, but kind of break through and then obviously get to a new all-time high. But we have to remember though that in these downturns, right? So here's the downturn from last year. So that top arrow there was the July 31st last year. The bottom was actually during our show on the 27th of October. And you can see there's a couple run-ups there.
Yeah, there's a couple of bounces back up.
So when we look at what's happening right now, that's why we want to see break trend, get to a new high before you get too excited. There's a couple things that strike me. Usually once you've come down 5%, you're going to come down some more because there's kind of like some damage done to the market, and that's what happened here last year, right? Yes, you're going to get some run-ups and, people get excited. There's something that happens. They're short covering, whatever it is. But until you kind of get back all the way, you got to be tempered a little bit on your enthusiasm for where it's going to go. Because normally you'll end up something more like what we had last year with this type of downturn. However, I was thinking back to the second half of 2021 when the market was really strong, somewhat like it is now. And I remember talking about that and saying, hey, we're only down 5%. It's likely we could come down more, and it didn't. It just kept rallying off of that and kept coming up. And so this is again a really strong market. So you can see these shorter dips, this 5% type dip.
Yeah, going back to World War II, I believe there's about 230 periods that have gone 5% down.
Yeah, and
so that averages out to about one every 4 months.
Yeah,
and so it's very common in the market.
Yeah, that's a good point. It's how it works. It's a stock market is a representation of human emotion, in my opinion, and we don't go in a straight line, especially as a group. So you don't normally see markets go straight up like we have actually had happen, in this last turn. And so now we're finally getting that little downturn. Again, I think this is very healthy. And so what's happening this week has a lot to do with a couple of different areas. So first of all, we had the gross domestic product that came out this week. So for the first quarter, 1.6% annualized. Okay. So if you think about it, things are slowing down a little bit. The third quarter of last year was a little over 4% annualized GDP. Then the fourth quarter of last year was, a little over 3%. And now we're at 1.6%. So, things are slowing down a little bit. That's not a bad thing in an inflationary environment. Unfortunately, inflation is actually picking up. We've got
Yeah.
the PCE number that came out. We're annualizing at about 3.7% for the first quarter, whereas we were annualizing 2% for the last half of last year.
Yeah.
So inflation's up and GDP's coming down. You get into the neighborhood of what they call stagflation, where theoretically you have no growth and still have high inflation. I wouldn't say 3.7% is high inflation
Yeah.
per se. I mean, in historical standards, it really isn't. But you're kind of in that area that's a little bit interesting. But the biggest thing that's happening, as far as I'm concerned, this week has to do really with the earnings, because this is earnings season. And so this is a chart. So on the left-hand side there's a blue line and the scale for the S&P 500, right? This goes back 20 years. And on the right-hand side is the scale for the earnings per share for the S&P 500. So $188 or whatever it is per share is the earnings coming out of the S&P 500. Currently. So you can see, first of all, there's a fairly strong correlation between earnings and, the stock market. Sometimes earnings are ahead, sometimes the stock market's ahead, but overall, that's pretty important. But if you look more closely, you can see earnings have kind of flatlined there a little bit for a while. And, we're almost back to where really record earnings per share, which happened, back at the end of the 2020 run, the end of 2021, actually. And so, that's why the market's coming up, and maybe the market's a little bit ahead of itself. So we'd like to see earnings growth. And so that's why it's important to look at what's happening. And we're seeing, I think, very good earnings growth, coming out this quarter. For the most part, again, we look at any individual company, you can see something going on, but if you look at the whole market, it's not too bad. And of course, here's the PE ratio. So this is a fairly important concept where they take the price of the S&P 500, they look at the earnings, and they figure out, what's the ratio. So if you take that last chart, the ratio between the price and the blue line and the orange line is this. And so you can see, this is again the last 20 years. Those gray areas are where there's recessions, and so oftentimes the PE ratio goes skyrocketing high because earnings drop so much. And we're at 26 PE, so that's not cheap. You can see that here. It's not really, really expensive either. I believe the average here is around 22. So, but that's why earnings are important, and continuing to see growth in earnings coming through, I think is going to be important, because if you really want that stock market to continue to do well here and not take too many breaks, you're going to have to see, I think, some higher earnings. And luckily, on a projection basis here, you can see, earnings are expected to continue to grow, right? And so that's good. 12, 13%. In theory, the stock market could match that and do that 12, 13% type gains also. So anyway, that's what's happening right now. We've had, great earnings from, Google. And then Google also offered a $70 billion stock buyback, and actually it's called Alphabet now, and a dividend, their first dividend ever, right? So the market's up, pretty good today based on that. Was down, the day before, right, yesterday, because of what Meta did, after hours. And I don't think the Meta thing's a big deal. I'm not surprised to see that this week's up, even with the Meta, getting sold off. It was off like 12, 15%, because Meta, they keep talking about the metaverse, and every time they do that, I remember one of the times it dropped 40% after an earnings call in 2022. And so, Wall Street gets nervous about that. Are they putting too much resources into something, that is so far out there? So, take that with a grain of salt. But I don't think that's going to affect the market more than it did. Matter of fact, yesterday we saw some buying coming in, even during the downturn that was
Yeah, people
happening.
were trying to get into the dip buy.
Yeah, and so in essence, that's kind of what's happening here altogether. And then kind of the last thing is just because the market's really working itself, hard on when the Fed might be cutting rates, right? I mean, that's a really big one. And there's a kind of an interesting chart here that just shows, kind of going back to '68, how long it was between the last rate hike and then when they finally did a cut.
Yeah.
If you look down there, the average is just a little bit over 8 months. We're right at 9 months now. The last rate increase was the 27th of July. Sorry, 26th of July. And so that's kind of, um, I think that we're probably a ways away from a rate cut. Yes, we're seeing some slowing down of GDP, but we're seeing so many other areas. Consumer spending has been strong. The labor market's good. Yeah.
If you want, there's still a strong labor market, and the Fed's happy with that.
Yeah, the labor market does lag, right? Generally speaking, but the Fed has a dual mandate. One of which is to keep the, what they call full employment, which essentially means 4% unemployment or better.
Yeah.
And we're there. I think we're at 3.8. So they're not worried about that. They're not going to cut rates to make full employment.
Yeah, I think it's a record amount of time that we spent under 4% unemployment.
Yeah, and it's kind of amazing, actually. And there's still so many open jobs. It's incredible. And I think, and we've seen, and today we saw from the PCE number, PCE is the personal consumption expenditure price index, which is the favored measure of inflation, that most of the inflation came out of services.
Yeah, service. I think it is 0.4% month over month.
Yeah.
Services.
And so that's the key right there. It has been for quite a while. We had an inflationary push on goods, during the pandemic when we couldn't do services. We shifted money towards goods. And of course, now, that we can go out and do things, the services are the issue. And that's really labor related for the most part. And with the number of open jobs, that's where inflation's going to continue to be hot. So when I look at, because that to me is it doesn't lag as much, in other words, as it does, say, the unemployment number. And so when we look at the number of open jobs, and you look at that being so high historically, and it has come down some, which is nice, it just means that it's going to get kind of competitive to get an employee. If you've got somebody at your restaurant that wants to buy food from you, you might pay more. And we talked about that last time you saw at a restaurant, one of the restaurants paying $26 an hour here local. Why would they do that? Because they need the person.
Yeah, they understand they can make a profit if they get the person in,
Right.
So they're going to pay the extra money.
Yeah, exactly. And even if it's just kind of breaking even for the short term, because you want to keep your customer flow going, right? And have that momentum and stuff is so hard to get, So if people are having to stand in line, they might not come back. And then when things get better and, you get more profit per employee, that person isn't coming back to your restaurant. So sometimes you're better off just kind of keeping things rolling as a business. So labor is a really big piece of this. But, the Fed cutting rates is a big deal because the market has historically done quite well off of those rate cuts and what have you too. So, it's been a really interesting time frame because we're still seeing some higher inflation. We're seeing some lower GDP. There's a lot of forces crashing into each other. We are seeing a lot of new hires. Every report that we get out, once a month, they come out with that big report for, it's 300,000 plus new hires, which is good. That is going to help the inflation scenario. So overall, I think the market's really kind of in the right spot here. I'm not sure that this downturn's over, but it could be because that's what we saw in the last really strong market in end of 21. There wasn't any particular support that it bounced off of, which would make me feel more confident. But nonetheless, in a very strong market, you can get these types of things. And then certainly in earnings season here, if we get enough upward surprises, or sometimes it's not even the surprises that really drive it's what they're saying and what they're projecting going forward.
Yeah,
right?
and when it's the major companies too, it kind of brings everyone else up.
Yeah, it's a weird thing. Those calls are kind of funny if anybody's ever listened to them. They're kind of in a tough spot because, if you say that you think things are going to be softer in the future, your stock's probably going to get hammered, but you'll have the advantage of being able to jump over a lower hurdle, right? But if you say, hey, we're doing better than expected in the future, the stock's probably going to do well. So if you want the stock to do well right now because it hasn't been doing well, you'd want to say that, but then you do have a bigger hurdle to jump over for that next quarter. So it's kind of fascinating how that works. And generally speaking, the forward guidance is less than, on average, less than what they actually end up doing. And so once in a while you get a company that's just doing so fantastic like NVIDIA, they'll blow away the expectations on forward guidance and then blow that away too, just because they're just doing so well. But that's not the norm within that grouping. So anyway, that's what happened this week. Again, I still think this market is very healthy. Primary trend is up as far as that goes. And so there's nothing really to worry about here. It's nice to see that this week is positive finally. And maybe we get back to a new high here. I'd like to see us break out of the trend, get back to a new high, and I feel really good about where we're going as far as that goes. So, again, earnings need to continue to come up, and so it'll be interesting to see what the rest of these reports are like. So, anyway, that's what's happening this week. Thank you for joining for that section, and appreciate it. Let's get into our first questions.
So, why is the market brushing off the hot PCE? Inflation report today? Every time CPI comes out, we've kind of had a big down day.
Yeah. So let's just define that. So PCE is personal consumption expenditure, right? So that's the favored measure of inflation that the Fed likes. Most people don't know that. CPI is the consumer price index, right? That's the one that most people know about. Different basket of goods. They can be quite different, actually. I think it's because of the reporting, timeline for starters. So you get CPI, right, earlier, within a couple weeks of the end of the month.
Yeah, usually the second week of the month.
And so, that comes out. That's the first adjustment that the market might make, even though it's not that related to PCE. It still shows some inflation. They've got a really weird way that they measure, things like rent and what have you.
Yeah, they're very much PCE. There's kind of, you switch baskets, like, it's more realistic to the real life. If apples are expensive, maybe you buy a different fruit like bananas.
Yep.
But CPI doesn't really do that switching.
Yeah, it's a fixed. You just have apples in there, forever until they change the basket. They have changed the basket once in a while, but you also get right after CPI is PPI, which is the producer price index. That's an inflation report from wholesale inflation, and so by the time you get to PCE, which is always right at the end of the month, essentially. There's a lot known already. They've come out, even in this case, we had the GDP that came out, gross domestic product, a lot of acronyms.
Yeah.
But, we have this situation where, a lot's already known. By the time we get to the PCE at the end of the month, I actually don't think the market would brush it off if it was surprisingly low or high.
Yeah, I think it was kind of within their range of expectations.
It was a little higher than expected, right? Just barely, but nothing, it didn't blow away. I think if it did, then the market would react, because it would be new news. But I think you're right. I think there's a window there that's already been established by the CPI and the PPI and all the other things that have come. By the end of the month, we kind of know what PCE is going to be. And I can't remember it being a surprise enough to move the market, so it usually doesn't as far as that goes. However, it is the most important number. It's the number I follow all the time, that I'm very interested in. And again, if you look at PCE, if you look at the second half of last year and you annualize that out, we were at 2%. Inflation. That's what the Fed wanted to be. That's why the markets took off. If you look at the first quarter of this year and you annualize the first quarter PCE, we're at 3.7% inflation. So that's troubling. But if you look back over the entirety of the whole thing as it's come down, over the last 3 years, up and then down, we've had lots of these quarters that are hotter than expected. The market usually does suffer, at least go sideways in those time frames. Matter of fact, that's a bit of what happened last summer, right? End of July to the end of October, that 10% downturn was in a time frame when inflation was being reported at higher levels, right?
Higher than expected.
And then all of a sudden it started to come back down in that fourth quarter, and whoosh, the market kind of took off. So it's not a straight line, at all, actually. So it is concerning that it's up.
It's different sectors of the.
Yes.
So like food prices and goods have kind of stabilized and are coming down. They're not rising as fast as they used to be. As just environmental factors or just production is meeting demands.
Yeah, and when we say coming down, we don't mean that the prices are actually dropping. It means it's just going up
It,
slower.
it's just growing slower. Yeah.
Because I get called on that all the time with the clients when I'm talking to them. Like I don't know, stuff is still more expensive, and they're right. But it's not going at 9%. It might be going at 3%, or food is
Yeah.
actually even going faster because it's just one of when they report this number, it's the kind of the whole basket, and each piece of the basket is weighted in a different way, and that kind of thing. So the inflation that we're used to seeing a lot of times is related around food because it's a consumable that we're doing every day.
Yeah, and when you go to the grocery store and you buy something and it's like more expensive the next week, it's
Yeah.
a noticeable difference.
Yeah, exactly. Yeah, you go to a restaurant and maybe you're ordering the same things a lot, because you like that, and you kind of remember what it used to cost, and now it's costing a fair amount more, between, higher labor costs, well, either whether it's forced through minimum wage or just forced because the market, makes it so that you got to pay more even than minimum wage to get a server in there or what have you, a cook or whatnot. So it's really interesting to see what's happening. But yeah, I think PCE is partly, and inflation as a whole is partly why the market has been kind of, what is it, last 5 or 6 weeks now. I think we're basically kind of in the same spot, more or less, right?
Yeah.
And so that, we have to let that play out. If it continues to go up, we're going to have some trouble. The market's not going to continue to go up in that environment. So if inflation
Yeah.
continues
Even
to be,
with good earnings reports.
yeah, even with good earnings reports, I think, at least in the short term, earnings do drive things in the longer term, but in the short term, the market's going to be very concerned about higher inflation. So these reports are important. We'll see how they play out, but it's going to be just something we have to wait for as far as that goes. All right. What's our next question?
Should I avoid my 401k if there's no match and just max out my IRA?
Okay, so 401k is you can contribute through your work for a for-profit company, which would be
Yeah, and 403b is the nonprofit
Yep.
or the government
Yep.
equivalent.
Yeah, they've got 457 plans. They got a lot of different plans, but uh, for-profits, often have a match, right? But not always.
Yeah.
And so you put in, $100, and they match that. So $200 goes in, and up to a certain percentage of your pay. Some companies do really high percentage, some do really low, and some do zero. So if you're not getting a match, you could add to an IRA because you don't get a match there either. So
Yeah.
those are equal on that footing. So there's kind of some pros and cons to both. So if you look at a 401k, first of all, the biggest pros that I can see are you can add a lot more, right?
Yeah, it's 23,500 versus $7,000.
Yeah, so
without catch up.
that's huge amount. Now, if you're going to put in 1,000, then it doesn't matter. But if you want to put in more than the 7,000, right, then the 401k would allow you to do that. The other thing that a 401k has, it's protected from creditors, right?
Yeah.
Both IRAs and 401ks are protected from your own bankruptcy, but a 401k is protected from a creditor coming after you. Honestly, I've never seen that with any of my clients ever. That's because our clients have money. They're not dealing with creditor issues, but it is one of the things. 401k you can withdraw right at 55 if you've left that employer past that age.
So with your last employer, you can withdraw from that 401k. So if you have an older 401k with a different company, you can't withdraw from that one without penalty.
Yeah.
So it's only that 401k. So that's a nice perk if you're kind of getting close to that 55 to 59 range.
Yeah, because 59 and a half is when you can withdraw from IRAs without penalties. So that's a difference. The biggest difference in IRA is the ability to use anything. So because a big disadvantage of a 401k is they usually have this small list of options to choose from, and we help manage a lot of 401ks, and it's kind of frustrating. You got a lot of target date funds, which in my opinion have been underperforming the market because of their large percentage in international, right, which has been underperforming the US market. And so I can't, if I use a target date fund, I can't get out of that international exposure. Maybe international does great and you'd be happy to have it, but man, it's been a really long time since that's been true. And so then you have these other options that are limited to kind of create your own portfolio, whereas with an IRA, you can use anything at all. Well,
whatever your
whatever,
provider,
yeah,
but
whatever
you have
your
a bigger
brokerage
list.
firm, yeah, it's a, well, yeah, it's like, a 30 versus 20,000, right? I
Yeah,
mean,
yeah,
so that's a big difference. And so theoretically, the more choices you have, the better you can construct your portfolio. Certainly, I think that's true for us. And the higher rate of return you can get by having more options. So that's the big advantage of an IRA. So maybe, you split the difference. Yeah,
yeah.
because there's
So
pros and cons to both.
if you like, let's say you want us to do $14,000, you
Yeah.
could do 7,000 each.
Yeah.
So you're still kind of reaping the benefits of both, but you can also be able to tax defer all of that, because if you're just doing your IRA only, you'd have $7,000 that you want to save, but you'd have to do taxable there, and then that'd be a different kind
Yeah.
of bucket.
Yeah, that's right. Yeah. So anyway, that's a good question. It's kind of a strategy. These are the types of things that I think are important. As you head into retirement. In this case, you would be heading into retirement if you're talking about contributing to a 401k and not already in retirement. And so in that particular case, understanding all the pros and cons of where you can put your money. Not just, because most people are looking at what about this stock or this, ETF or whatever, but you also need to look at the tax consequences and the other things that have to do with the vehicle. If you're going to buy NVIDIA or something in an IRA or whatever, understand what is it a Roth IRA or traditional IRA, and that has a lot to do with kind of the tax planning portion of the, retirement. And these things are equally as important, in my opinion, as getting the right investment.
Yeah, I think just getting the habit of saving is your priority one, and then
Yes.
optimizing where you save it.
Yep.
And you could get very far with just those two things.
Yeah. Yeah. Yep. Exactly right. Good question. All right. So what's our next question?
When and how do I cut the cords for my adult children? I'm still paying their car insurance and phone bills.
uh, that's a good question, right? I mean, because these are your kids. Obviously, we don't know from this question, some of the background, or, are the adult children fully employed or not?
Yeah.
If you're cutting them off, what was the question? It was for insurance and phone bill?
Yeah, car insurance and phone bill.
Phone bill, okay. So, you don't want them to, not have car insurance
Yeah, that'd be a
because they
big-
don't have a job, because that could come back to haunt you too. And so let's assume that they have a job. Then personally, I'm cutting them off pretty quick as far as that goes.
Yeah.
The phone bill's kind of a weird one though, because the way these family plans work and such, and it's not super onerous to keep the kids on the phone bill, but with car insurance, I would like to have the kids be financially independent, and also, making sure that that car and that car insurance is both in their names.
Yeah.
I feel like, and I'm not a lawyer, so I'm not positive, but I feel like that gives a little bit of insulation from my personal wealth, right? From my kids getting in an accident, right?
Yeah.
So that is something I'd advocate, because I have seen that actually, where one of my friends' son got in an accident, and then they sued him because the car was still in his name.
It's titled in his
And
name.
he'd never even driven the car, it was his son's car. They just hadn't moved the title, into his name after he turned 18. And so those are the types of things. But there is the other strategy is, hey, I've got a child who isn't getting out there and isn't getting the work done.
Yeah, so
right?
how can I force them to kind of...
Yeah, so I have a strategy that I've been advocating for a while, which is just, you say, all right, it's X amount. Let's just say it's $3,000 a month for that child to be out of your house, in their own place. Maybe it's shared or whatever. I'm making up the numbers here, but and so you sit down with that child who's still struggling to find a job or keep a job and say, okay, this is what's going to happen. I'm going to pay $3,000, and then over 3 years, I'm going to reduce it by 136 basically.
Yeah.
So I'm going to take off, a couple $100 a month, and you've got to make that couple $100, right? And then the next year it's going to be 400. And so, you know what I'm saying? So over a 36-month period, you're going to go down to zero.
Yeah, so they got to figure out how to make the money.
Yeah, and so I think, that way you're not throwing them out in the street. The amount that they got to make up front is quite small, and then they kind of can build that up. And if they make more than that, great. Hopefully they save it or, whatever. But, you're basically committed to this kind of 36-month ramp down.
So would you switch all their bills and stuff like that into their name at that start of that period, and then kind of provide them the funds to pay the bills?
Yeah, yeah, ideally, exactly right. And because then, I think that bridges this kind of gap where you've got a scenario where, the kid's having a hard time getting started. And I've seen this both within our own family and within, the families of some of my clients, right? Where, some of the kids have a trouble getting going, right? And if you provide everything for them and keep doing that, it's hard for them to get motivated, at least financially. I know for me, I look at like my background, and I just my parents were middle class, definitely, but I wanted other things that they weren't willing to provide. I was working since I was 10 just to kind of get those things, and but if all that would have been given to me, maybe I wouldn't have been, as motivated to get
Hmm.
out there and work. And so this is a way to kind of, make it a softer landing, right? So, okay, I'm taking care of everything up front, but then it's going to reduce slowly but surely, giving you that. I'm making up the numbers. It could be less than 3 years, more than 3 years, but in this case, I'm giving you that 3 years to kind of get it going, you
Yeah,
know?
and if they're living at home and say you want to force them to kind of start to, in a sense, pay for expenses,
Yeah,
you could, but you don't really need them to pay. You could say, "Hey, I want you to save $1,000 a month or some
yep,
sort of
yep,
number,"
yep.
and then basically that would be your food costs or your rent or something like that, a combination. And that way they're saving money, but you're kind of teaching them to have that budget for that money.
Yeah, yeah, that's what I did. Exactly right. I mean, so instead of charging them rent or charging them for food, I just made it a requirement that a certain amount of money had to go into a savings account, brokerage account, something, because I think that that's a big deal to be able to, again, assuming the child has some income, right? But learning that saving habit, and you mentioned this early in the show. I mean, that's the number one thing that we see with our clients. That's they aren't all good at their tax planning, their retirement planning, their asset management. Some of them are better than others, right?
Yeah,
That's a big mixture. But one thing they're all good at,
saving money.
all of them, and that's the difference. And so that's from our own experience. It's the thing we've learned, from being in this practice, is that's the key aspect, is that ability to save money. So teaching your kids to save money, that's a good strategy. And so it kind of gets them on their own too. And then they're kind of used to, saving, but they're also used to having some money come out of their lifestyle, which is what's going to happen when they do move out, right? They're going to
Mhm.
have money going out, and their lifestyle might improve, not living at home or whatever, but there's going to be money that goes for that. So yeah, it's a good question. It's something we end up dealing with this a fair amount actually within the practice. So it's probably helpful.
So how do you balance savings goals like a vacation home, dream car versus retirement? How do you prioritize what and how much to save to each goal?
Okay, so let's just say I want to buy a vacation home, and if I do that, it's going to impinge my ability to save for retirement. If I save for retirement, then it's going to impinge my ability to get a vacation home, right?
Yeah.
So that's kind of a either or question. And so if you look at that, I guess the thing that strikes me is at some point you're going to be retired. You're not going to be able to work.
Yeah.
I'm planning on working until 75, but I turned 60 in a few months, and so I got 15 more years. But there's no guarantees that I can do that, right? Because
Yeah.
health and